Want to welcome everyone to part 2 of contributed capital. We're going to continue on with our common stock and preferred stock allocation. On this one, we're going to start with detachable warrants, which are going to be attached to the preferred stock in this case. In last chapter, we did the detachable warrants attached to bonds. This one's going to be detachable from preferred stock. And it's to make this stock a little more attractive is what it's for. So Rehash Company issues 1,000 shares of $50 par value preferred stock with detachable warrants of 110,000. So 410,000. So they received 110,000 for the 1,000 shares on January 1st, 2016. Each share of preferred stock has 6 detachable warrants attached to it. Each warrant entitles to purchase to 1 share of $5 par value common stock for $45. The warrants expire in 2 years. So the fair market value of the stock was $78,000 on January 1st, and the warrants selling for $7 per share. That's the idea of detachable warrants. You can take them away from the preferred stock, what they're attached to, and sell them and trade them separately. And that's why they have a value for it. So what we have to do is calculate the value. Well, the cash is real easy because that was given to us. That's 110,000. Okay. Then we're going to come down here and do some calculations though. The preferred stock was given to us at 78,000. That was given right there. That's what they said the value of was. For this common stock warrants, however, we have 1,000 shares, and remember each preferred share of stock has 6 warrants attached to it, and it's worth $7 for a total of $42,000. For a total of 120,000 altogether. Okay, and that's what we have here then. The amount that's allocated, this is the allocation. The amount that's going to be allocated to the preferred stock will be the 110,000 times the 78,000 divided by the 120, or $71,500. And the amount that will go to the rest to the common stock warrants, 110,000 times 42,000 divided by 120,000. Now, it's tempting just to subtract them, I know, but by calculating it, you can see, does this equal 110,000? And yes, it does. So it's kind of a check. It's dangerous to subtract because it may, if you have an error in the first part, it's going to show up. So we have preferred stock. In this case, it was for $50 par value. Okay, so that's equal to 1,000 shares times the 50, or 50,000. And then we have additional paid-in capital for the preferred stock. And that's equal to, well, we allocated 71.5 to it, minus the 50,000 we have recorded for it. So additional paid-in capital will be $21,500. And then the balance will go into the paid in capital for common stock warrants, and that's equal to what we allocated down here for the $38,500. Okay, now it's always a good idea to check, add those up to make sure, and it equals 110, so we're okay. If you highlight them at the bottom here, it'll show what the total is. Okay. So everybody's okay with that one. Everybody's happy. Now, if they exercise the warrants, what to do? We see, yeah, if exercised, we have cash. Well, that would be for the 6,000, because we said we had 6,000 warrants. I'll do it this way if you want. The 1,000 times the 6 times the 45. So it's 270,000 for the cash. And then we have the paid in capital, common stock warrants. That's for the 38,500. Then we have common stock. And that would be equal to the 1,000 times the 6 that each preferred stock times the par value, which I'm assuming was $2. No, it's $5, wasn't it? Messed up there. I changed it. So 30,000. And then we have the additional paid in capital for common stock will be equal to this one plus this minus 30,000, or 278,500. Okay. Then we have, and that's how you do. Now, if they're not exercised, this paid in capital common stock warrant stays on the balance sheet. Okay, as additional paid in capital. Then we have convertible preferred stock. This is preferred stock that can be converted into common stock. Recharge Company, Recharge, originally issued 600 shares of $50 preferred stock at $75 per share. This is convertible preferred stock. Each preferred share may be converted into 5 shares of $4 par common stock. Get that a little bit better. Okay. So we originally have. So what are we giving? We're giving up preferred stock. So we have preferred stock, and it was originally 600 shares times $50 a share, or $30,000. Then we also have to get rid of the additional paid in capital for the preferred stock. And that's equal to, again, the 600 shares times, well, it was originally sold for 75, so we have 75 minus the 50, or 15,000. Then what did they get for it? They received common stock. I'm capitalizing that. And this one is for $4 par. Okay, how many shares did they receive of that? Well, we have 600 shares, and each 600 preferred shares, and it's converted into 5 shares times $4, or $12,000. And of course, the rest of it will go into additional paid in capital for common stock, and that's equal to 30,000 plus the 15 minus the 12, or $33,000. Okay. Different course of action. That's how you do the convertible stock. Basically, you get rid of the stock that you're getting rid of, the preferred stock, and then find out how many shares of common stock they receive. Okay, according to par value, and then the difference will go into additional paid in capital. For the treasury stock, this is stock that we repurchase of our own. Again, it could be common stock or preferred stock. Now, we're going to record it at cost, which is the most common way of doing it. So purchase 200 shares of $1 par value common stock at $23 per share. Okay. Now, this is remember, this was our repurchase. It doesn't matter what we initially sold it for. So in this case, we would debit treasury stock. And some will put in here common, because it can be different. Okay, and it was $200 times 200 shares times $23, or $4,600. And of course, to purchase it, we had to spend cash, and that's going to be equal to the $4,600, just like before. Okay, now we sold, of that 200 shares, we sold 50 shares at $24 a share. So we received cash. This is equal to 50 times 24, or $1,200. We credit treasury stock. Now, treasury stock goes out at what we originally paid for it. So that would be equal to the 50 times the 23. Okay, 1150. And the difference will go into, additional paid in capital. this time for treasury stock. And that's for the, well, it'll be $1 a share. Okay, so it would be the 50 times, we've sold it for 24, it cost you 23, so it would be $1 a share or $50. Basically the difference. Okay. Now, you sold the balance for $21 a share, so that means we sold 150 shares. So we have cash, and it's equal to the 150 shares that we have left, the 200 minus the 50, and we sold them for $21 a share, and that's $31.50. Okay, now you have to think about, would we sell this at a gain or a loss? Well, we lost on this. Well, you don't show gains or losses. If you sell for less than what you originally paid for it, you take it out of treasury stock common first, not treasury, you take it out of additional paid-in capital for treasury stock, what you have in there, but you cannot take out more than what you'd put in. So in this example, we put in $50. So that's all we can take out. The balance of the loss has to come out of retained earnings. So for this, we would debit the additional paid-in capital treasury stock, and that's for the $50. Okay, so over here, if you want to do a little calculation, okay, we put in, basically, we know what we received. We received $31.50 for it. Okay, the treasury stock cost well, what it cost us was equal to the, let's see, 150 times the 23, which means our loss is $300. Well, 50 of it's already accounted for. So like I said, the difference has to come out of retained earnings. That's why treasury stock puts a restriction on retained earnings. And that will be for the 250, because the 50 of it came out of the additional paid-in capital. That's all we can take out of there. So the balance has to come out of retained earnings. Now, if you sell it, it does not go back into retained earnings if you sold some at a higher price. If that's where it comes out of. And then we would credit then the treasury stock for the $31.50, which is what we calculated over here. Okay. I know we don't have to do all that, but that's okay. You know, I want to just label that as a loss, even though you don't record it as a loss, you record it as a deduction to retained earnings. Okay, so that's how you have to do this. Now, on this one, it's a different, forget what we had above. You retired 200 shares instead of, so you bought stock back, but you decided to retire the stock instead of putting it in the treasury. Treasury stock you can resell. When you retire it, though, it goes out of the market. So if you decide to retire it, then you have to debit the common stock, because you're taking it off the market, and that would be for the, this is $1 a share, so it's $200. You debit the additional paid-in capital for that common stock. Okay, originally sold at $25, so that's equal to the 200 times the 24, or 4,800. And then, of course, you credit cash, and that will be for equal to the 200 times the 21, or 4,200. And then we go into additional paid-in capital. Retirement. And that's going to be what makes it balance. Okay, now these two are credits.